Joining us now is RBC Capital Markets Head of U.S. Equity Strategy, Lori Calvasina. Lori, so what's the strategy here? We're still above 5,000 after two hot inflation reads in a way that could be good news. I mean, if you're looking, if you were guessing, I guess, what was going to happen with CPI and PPI and how the market would react off of these highs, you might not have guessed this, but your bull case is quite a bit higher.
Yeah, so look, we've got 5,150 as our year-end price target on the S&P. One of our models is pointing to 5,500 as a potential bull case, and that's really based on our valuation work, which takes into account things like moderating inflation, a little bit of relief on interest rates, and a recovery in GDP in the back half of the year. So that's not our base case, the 5,500, but it is something that could potentially be reasonable if we end up being too conservative. You asked, John, kind of what the strategy is here. I think it was a really, really weird day. We saw both small caps and REITs getting hit very hard alongside big cap tech and communication services. And you usually don't see both of those sets of sectors or indexes at the bottom of the pile. I think I would really caution people in here to stay focused on the big picture. We do think inflation is moderating. Our rates team has been telling us it would be a bumpy ride down for quite some time, so we're not overly alarmed here. But I would keep an eye on the big picture and where we're headed, not the bumps along the way.
Okay, you're also saying that investing is in the process of a post-COVID normalization. What's the new normal going to look like?
Well, it's a great question. And I'll tell you, as I think back to my meetings, really over the last 6 months, back in the fall, the winter, and even the last few weeks, this is something a lot of investors are interested in talking about. I've really been pushing forward the idea that similar to the post-tech environment in 2002-03, similar to post-GFC in 2010, 2011, 2022 through early 2024 have really been that era of post-COVID normalization where we're figuring out what all the new rules of the road are. I do think we have to get used to higher inflation than what we saw before, higher interest rates. I also suspect that GDP growth is going to be more robust than what we saw in the post-GFC period. And I think that's why we keep having these constant upside surprises that the street's not ready for. I think that you have to play for all of those things. And I think you really have to look at, multiple cycles, not just a post-GFC period, to figure out things like where your valuation multiple should be.
It's a really interesting take that you have, especially in a week where we've had so many debates on our air and so many strategist notes circulating about the Rorschach test. That is this 95 for the markets or 99 for the markets? And you're basically saying, I'm looking at different periods altogether. Yeah. The fact that we did see, we saw the major averages finish the week lower. But in terms of what outperformed for the week, the Russell 2000 still finished the week up 1.3%. And if you look at the sectors that performed well, it was some of these more cyclical sectors. It was things like materials and energy and financials. You even saw utilities and healthcare catch a bid here in this market. Can we say that the rally is broadening out here, or do you need to have more evidence?
I think that we're seeing hints that people are ready for the rotation and ready for the broadening. If you even look at the conversation about the Mag 7, a couple of those have been kicked off in Darwinistic fashion, right? So now people are talking about their top 5 favorites, their top 4 favorites, even their top 3. I think that gives you a hint right there that people are really ready to do something else. And if I think about those sectors that did well today, really, yes, it's cyclicals, but it's also things that have lagged. And that's really capturing a little bit of the excitement, that we saw back in the fall. I think that if you think about what people have been angsty about over the last week or so, I'll tell you my conversations last week. I was overseas. The question I kept getting was, oh my gosh, is the U.S. economy so hot that the Fed can't possibly cut? Well, think about that premise here. The U.S. economy is so hot. That really is something, I think, a feature of this new normal, again, that we have to get used to more resilient consumers, better than expected GDP than what we saw in the post-GFC era. And I think you're starting to see, we're kind of working through the wrangling out of this Fed angst that developed. People got a little bit too excited there, and they're trying to start focusing on that idea of an economy that's actually pretty healthy and invest accordingly. So we're in this weird transition period. We've got to work through this Fed angst, but we've also got to come to grips with the idea that consumers are in pretty good shape and the economy is in pretty good shape.